Chapter 4. Indicators and Tools. As JuJu's confidence grew, James decided it was time to explore the various indicators and tools that could enhance his trading strategy. Indicators are like additional lenses that can help you see the market more clearly, James explained. They began with moving averages, one of the most widely used indicators. A moving average smooths out price data, making it easier to identify trends, James said. There are different types of moving averages, such as simple moving averages, SMA, and exponential moving averages, EMA. JuJu was curious. What's the difference between them? James explained that a simple moving average calculates the average price over a specified period, while an exponential moving average gives more weight to recent prices, making it more responsive to recent changes. Both have their uses, but EMA is generally more sensitive to recent price movements. They practice plotting moving averages on various charts, discussing how they could be used to identify trends and potential entry and exit points. James emphasized the importance of using moving averages in conjunction with other tools and techniques. For example, James said, pointing to a chart, when a shorter moving average crosses above a longer moving average, it's called a golden cross and can be a signal to buy. Conversely, a death cross occurs when a shorter moving average crosses below a longer moving average, signaling a potential sell. JuJu found this concept extremely useful. He realized that moving averages could help him identify trends and make more informed trading decisions. Next, James introduced JuJu to Bollinger Bands, another powerful tool for identifying overbought and oversold conditions. Bollinger Bands consist of a moving average and two standard deviations above and below it, James explained. They help us see how volatile the market is and identify potential reversal points. They practiced plotting Bollinger Bands on various charts, discussing how they could be used to identify potential trading opportunities. James emphasized the importance of combining Bollinger Bands with other analysis techniques. Look at this chart, James said, pointing to an example. When the price touches the upper Bollinger Band, it's considered overbought, and when it touches the lower Bollinger Band, it's considered oversold. These points can signal potential reversals, but always look for confirmation from other indicators or support and resistance levels. JuJu found this approach extremely valuable. He realized that Bollinger Bands could help him identify potential reversal points and make more informed trading decisions. They also discussed the importance of adjusting the settings of Bollinger Bands based on the specific market conditions and timeframes they were analyzing. James emphasized the need to experiment and find the settings that worked best for their trading strategy. As their sessions continued, James introduced JuJu to the Relative Strength Index, RSI, a momentum oscillator that measures the speed and change of price movements. RSI helps us identify overbought and oversold conditions, similar to Bollinger Bands, James explained. JuJu was eager to learn. How do we use RSI? James began by explaining the basics of RSI. RSI ranges from 0 to 100. Values above 70 indicate overbought conditions, and values below 30 indicate oversold conditions. It helps us see when a market might be due for a reversal. They practiced plotting RSI on various charts, discussing how it could be used to identify potential trading opportunities. James emphasized the importance of using RSI in conjunction with other indicators and analysis techniques. For example, James said, pointing to a chart, when the price is at a support level and RSI is below 30, it's a strong signal that the market might be oversold and due for a bounce. But always look for confirmation from other tools. JuJu found this concept extremely useful. He realized that RSI could help him identify potential reversal points and make more informed trading decisions. They also discussed the importance of adjusting the settings of RSI based on the specific market conditions and timeframes they were analyzing. James emphasized the need to experiment and find the settings that worked best for their trading strategy. With a solid understanding of moving averages, Bollinger Bands, and RSI, JuJu felt more confident in his ability to analyze the market and identify trading opportunities. James decided it was time to introduce JuJu to the concept of Fibonacci retracement. Fibonacci retracement is a tool that helps us identify potential support and resistance levels based on key Fibonacci ratios, James explained. JuJu was curious. How do we use Fibonacci retracement? James began by explaining the basics of Fibonacci retracement. The key Fibonacci ratios are 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels are based on the Fibonacci sequence and help us identify potential reversal points in the market. They practiced plotting Fibonacci retracement levels on various charts, discussing how they could be used to identify potential support and resistance levels. James emphasized the importance of combining Fibonacci retracement with other analysis techniques. "Look at this chart," James said, pointing to an example. "We have a strong uptrend, and the price is retracing to the 61.8% Fibonacci level. This level often acts as strong support, but always look for confirmation from other tools." JuJu found this concept extremely valuable. He realized that Fibonacci retracement could help him identify potential support and resistance levels and make more informed trading decisions. They also discussed the importance of adjusting the settings of Fibonacci retracement based on the specific market conditions and timeframes they were analyzing. James emphasized the need to experiment and find the settings that worked best for their trading strategy. As their sessions continued, James decided to introduce JuJu to the concept of pivot points, another powerful tool for identifying potential support and resistance levels. Pivot points are calculated based on the previous day's high, low, and close prices, James explained. JuJu was eager to learn. How do we use pivot points? James began by explaining the basics of pivot points. The main pivot point, P, is the average of the high, low, and close prices from the previous day. Additional levels called support S1, S2, S3, and resistance R1, R2, R3, are calculated based on this pivot point. James emphasized the importance of combining pivot points with other analysis techniques. "Look at this chart," James said, pointing to an example. "The price is approaching the main pivot point. If it bounces off this level, it could act as support. If it breaks through, it could become resistance. Always look for confirmation from other tools." JuJu found this concept extremely valuable. He realized that pivot points could help him identify potential support and resistance levels and make more informed trading decisions. They also discussed the importance of adjusting the settings of pivot points based on the specific market conditions and timeframes they were analyzing. James emphasized the need to experiment and find the settings that worked best for their trading strategy. With a comprehensive understanding of various indicators and tools, JuJu felt more equipped to tackle the complexities of Forex trading. James decided it was time to introduce JuJu to the concept of combining multiple indicators to create a more robust trading strategy. Combining multiple indicators can help you filter out false signals and improve your overall analysis, James explained. But it's important to avoid overcomplicating things. Too many indicators can lead to analysis paralysis. JuJu nodded, understanding the importance of finding a balance. How do we combine indicators effectively? James outlined several key principles for combining indicators. First, make sure each indicator provides unique information. Avoid using multiple indicators that tell you the same thing. Second, focus on indicators that complement your trading strategy. They practiced combining different indicators, such as moving averages, Bollinger Bands, RSI, Fibonacci retracement, and pivot points. James showed JuJu how to use these indicators together to create a more comprehensive analysis. For example, James said, pointing to a chart, you can use moving averages to identify the trend, Bollinger Bands to identify overbought and oversold conditions, RSI to confirm the strength of the trend, Fibonacci retracement to identify potential support and resistance levels, and pivot points to identify key levels for intraday trading. JuJu found this approach extremely useful. He realized that by combining different indicators, he could gain a deeper understanding of market dynamics and make more informed trading decisions. They also discussed the importance of backtesting and forward testing. James emphasized the need to test any new combination of indicators on historical data before applying it in a live market. Backtesting helps you see how your strategy would have performed in the past, James explained. It's an essential step in developing a reliable trading plan. As JuJu practiced combining indicators and refining his trading strategy, he felt more confident and prepared to tackle the markets. James decided it was time to introduce JuJu to the concept of algorithmic trading. Algorithmic trading involves using computer programs to execute trades based on predefined criteria, James explained. It can help you automate your strategy and remove emotional biases from your trading decisions. JuJu was intrigued. How do we get started with algorithmic trading? James began by explaining the basics of algorithmic trading. First, you need to define your trading strategy in precise, quantifiable terms. This involves specifying the conditions for entering and exiting trades, as well as your risk management rules. They discuss the importance of backtesting and optimizing the algorithm on historical data to ensure its robustness before deploying it in a live market. James emphasized the need for thorough testing to identify any potential flaws or weaknesses in the algorithm. Backtesting is just the first step, James said. Once you're confident in the algorithm's performance, you need to forward test it in a simulated environment to see how it performs in real-time market conditions. They spent the session discussing various platforms and tools available for algorithmic trading. James introduced JuJu to popular programming languages used in trading algorithms, such as Python and MQL4/5, and recommended some resources for learning these languages. Learning to code can be challenging, but it's a valuable skill for any serious trader, James said. There are plenty of online courses and tutorials to help you get started. JuJu was excited about the prospect of algorithmic trading. He realized that automating his strategy could help him stay disciplined and remove emotional biases from his trading decisions. They also discussed the importance of continuously monitoring and refining the algorithm. Markets are dynamic, and conditions can change rapidly, James warned. Always be ready to tweak and optimize your algorithm as needed. With a solid understanding of various indicators and tools, JuJu felt more confident in his ability to analyze the market and identify trading opportunities. James decided it was time to focus on developing a comprehensive trading plan that incorporated everything they had learned. A trading plan is your blueprint for success, James explained. It provides a framework for making trading decisions and helps you stay disciplined and focused. They spent the session outlining JuJu's trading plan, starting with his goals and objectives. What are your short-term and long-term goals? James asked. JuJu thought for a moment. In the short term, I want to build consistency and confidence in my trading. In the long term, I aim to achieve financial independence and possibly manage a small fund. James nodded approvingly. Good. It's important to have clear goals. Now let's define your trading strategy. They outlined the key components of JuJu's strategy, such as the types of trades he would focus on, e.g., swing trading, day trading, the indicators and tools he would use, and the criteria for entering and exiting trades. Next, let's talk about risk management, James said. How much are you willing to risk on each trade? JuJu had learned the importance of risk management from their previous sessions. I'll risk no more than 1 to 2% of my trading capital on any single trade. James nodded. Excellent. Now let's define your risk/reward ratio. Aim for a minimum of 1 to 2 to ensure that your winners outweigh your losers. They also discussed the importance of maintaining a trading journal to document each trade and the emotions and thoughts behind it. Reflecting on your trades will help you identify patterns in your behavior and improve your decision-making, James emphasized. By the end of the session, JuJu had a comprehensive trading plan that incorporated all the principles and techniques they had discussed. He felt more prepared and confident, knowing that he had a clear roadmap to guide his trading decisions. Thank you, James, JuJu said sincerely. I feel like I have a strong foundation now. James smiled. You've done great, JuJu. Remember, trading is a journey. Keep learning, stay disciplined, and enjoy the process. With that, JuJu left James's home, ready to tackle the markets with renewed confidence and a clear strategy.